UnitedHealth Group reported their full year 2023 results on January 12th. Despite inline earnings, the shares sold off. We'll look at those results, provide some fundamental analysis, and at the end, give a rating for UnitedHealth Group. UnitedHealth Group is a healthcare and well-being company. Their year-end revenue was up 14.6% to $371 billion. Operating margin stood at 8.7%, improved by nearly 14% to $32.4 billion. Pre-tax income was $29.1 billion, with net income up 11% to $22.4 billion, or 6% of revenue. UnitedHealth Group's market capitalization is about $487 billion, ranking 16th of the U.S. largest public companies. Looking at the firm's 5-year income, we can see the company's revenue has been growing at a 9% compound annual growth rate. Operating margins have been growing at 10.5% and net income at 10%. UnitedHealth Group has two business lines: UnitedHealthcare, which provides healthcare benefits globally, and Optum in the health services business. The UnitedHealthcare unit has been growing at 7.7% to $281.4 billion, and the Optum segment at 15% to $226.6 billion. If we turn to the market value ratios, we can see equally positive numbers. Note that shares outstanding were down 12 million, or about 1.3% year over year, helping per share data. In fact, the company has been buying back shares since at least 2018. Earnings per share came in at $23.86, up 12.6%. Sales per share were $396.20, up 16%. Cash per share was $31.60, better by more than 14%. Book value improved 17% to $100.66. The company has a current price earnings multiple of 21.76 compared to the S&P 500 at 25.87 at the time of this writing. The PE growth is solid at 1.72. Leverage ratios demonstrate the company is not over-leveraged, with 21 cents of debt for every $1 of assets. Debt to equity is 0.62. Interest expense at 10 was worse, however, as interest payments grew faster than operating income. Liquidity ratios have been consistent over the last 5 years, with current ratio at 0.8, the quick ratio at 0.5, and cash ratio at 0.3. Return on assets were 8.2%, not much changed year over year, as was the return on equity at 23.7%. UnitedHealth Group's equity multiplier is 2.9. The company's cash flows were solid. Operating cash flow was up 11% to $26 billion. Investing outflows were just $15.6 billion, less by 45%. The firm has slowed down its acquisitions in 2023. Financing outflows were $11.5 billion, with free cash flow to the firm up 8.8% to $25.4 billion. UnitedHealth Group kept paying its dividend at $7.21, yielding 1.4% and growing at 14.3%. The enterprise value of the company is around $516 billion. That being said, that is a multiple of 1.39 to revenue and 20.3 times to free cash flow. Market cap to net income is 21.8 times. Guidance is expected to see earnings per share growth between 13 to 16%. Using a net margin of 6%, revenue is expected to be $394 billion in full year 2024. UnitedHealthcare is trading at a forward PE of 19.2. Key takeaways from the report were mostly positive: good revenue growth, good margin growth, good dividend growth, strong free cash flow. We were hard-pressed to find any weaknesses in the report. The PE is near the PE of the S&P 500, which is tech-heavy, and UnitedHealthcare isn't a tech stock, but because of its lead in the market, does command a premium price. The shares are trading near its all-time high. United has agreed to sell its Brazil business and expects to take a $7 billion non-cash charge, so this could drag on next year's net income. We rate the company a buy, and of course we have no exposure to this company. Like and subscribe.